Welcome to Tech Disruptions, deep dives into the technologies reshaping industries, from AI to quantum to biotech. Let's get into it.
So imagine this, a colossal, almost unfathomable amount of money, roughly $1.65 trillion, being poured into something that's supposed to be the future. But then, whispers start circulating that this enormous investment might be hidden away, off the books, in a way that's drawing comparisons to one of history's most infamous corporate scandals, Enron.
That's right. The scale of capital expenditure going into building out the infrastructure for AI, everything from advanced GPUs to massive data centers, is truly unprecedented. And the concern isn't just the sheer cost, but how some of these investments and their associated liabilities are being accounted for, or rather, not being fully accounted for on main balance sheets.
Enron is a pretty loaded comparison. Is the discussion about outright fraud here or something more structurally opaque? Because if tech giants are playing fast and loose with their books on this scale, that's not just a whisper. That's a potential earthquake.
It's certainly a strong parallel that demands scrutiny. The core issue isn't necessarily fraud in the Enron sense of deliberately faking assets or profits from non-existent contracts. Instead, it's about the sophisticated financial engineering being used to keep a staggering amount of debt and associated assets off the primary financial statements of these companies. It makes their financial health appear stronger than it might actually be, and that opacity is where the comparison to Enron gains some traction.
The 1.65 trillion figure is worth examining first, because it's a number that's hard to comprehend. What exactly is that money buying? Is it just chips, or is it a whole ecosystem?
It's absolutely an entire ecosystem, and it's a rapidly expanding one. Think of it as the foundational layer for the entire AI revolution. That 1.65 trillion isn't just for NVIDIA's latest GPUs, though those are certainly a huge component. It encompasses the construction of vast new data centers, which are essentially purpose-built, highly specialized factories for computation. These aren't your typical server farms. They require incredible power delivery systems, advanced cooling solutions to handle the heat generated by these powerful processors, and the real estate to house it all.
So it's not just the silicon. It's the physical plant, the electrical grid connections, the cooling towers, everything.
Precisely. And it's also important to consider the networking infrastructure required to connect all these GPUs, the specialized software licenses, and the personnel to manage and maintain these incredibly complex facilities. It's a massive capital sink, driven by what's essentially an arms race among the largest tech companies to establish dominance in AI. Everyone is trying to build out as much compute capacity as possible, as fast as possible, believing that whoever has the most powerful infrastructure will ultimately win the AI race.
It sounds like building a new national railway system, but for data. And the source implies that this build-out, this massive expenditure, isn't always appearing transparently on the books. How does a company hide a multi-billion-dollar data center or a warehouse full of GPUs from its main balance sheet?
This is where the financial engineering comes in, and it's a technique that has been used in various forms for decades, sometimes legitimately, sometimes in ways that invite scrutiny. The core mechanism involves what are often called special purpose entities, or SPEs. Think of it like this. A large tech company might set up a separate, legally distinct entity, perhaps a subsidiary or a joint venture, specifically to build, own, and operate these AI data centers, or acquire the massive GPU clusters.
So the parent company doesn't directly own the assets or the debt.
Exactly. This SPE then takes on the debt to finance these enormous purchases, the land, the construction, the GPUs. Because it's a separate legal entity, in certain accounting scenarios, that debt and those assets don't appear directly on the parent company's consolidated balance sheet. The parent company might then lease the capacity or services from this SPE, and those lease payments appear as operating expenses, not as direct liabilities from asset ownership.
So instead of showing a massive loan to buy $1 billion worth of GPUs, they show a recurring payment for AI compute services or data center rent.
That's the essence of it. It transforms what would be a long-term capital expenditure, requiring substantial borrowing and thus appearing as significant debt on the balance sheet, into more manageable, recurring operational expenses. This can make the parent company's balance sheet look much healthier, with less reported debt and potentially higher returns on assets, because the assets themselves are held elsewhere.
That sounds incredibly beneficial for a company looking to attract investors or maintain a high stock valuation. Is that the primary driver here, the optics?
The optics are definitely a huge part of it. In a hyper-competitive market where investor confidence is paramount and stock valuations are tied to perceptions of financial strength and growth potential, presenting a lean, agile balance sheet is highly advantageous. If a company can acquire massive AI capabilities without appearing to take on an equally massive amount of direct debt, it can make them seem more financially sound and less risky to investors.
It's like someone buying a luxury car but leasing it so it doesn't show up on their personal loan statements as a huge car payment, even though they're still paying for it every month.
That's a reasonable analogy for the underlying principle. It allows companies to leverage significant capital to build out critical infrastructure without immediately impacting their core financial ratios in a way that might alarm shareholders or credit rating agencies. It's about optimizing financial reporting to maintain a strong market position and continue attracting investment into an incredibly capital-intensive sector.
Okay, so the motive is clear. But then comes the Enron comparison. Enron wasn't just hiding debt, they were creating fake assets and manipulating earnings. Is this AI build-out situation truly on that level, or is the comparison more about the spirit of obscuring financial realities?
It's crucial to distinguish. The Enron scandal involved outright fraudulent accounting practices, including marking future non-existent contracts as current profits and deliberately misleading investors about the performance of their special purpose entities. The assets themselves were often overstated or fabricated. Here, the assets, the data centers, the GPUs, are very real. The services they provide are real.
So the assets exist, and they are being used. It's not a shell game of nothingness.
Exactly. The comparison isn't about fabricating assets, but about the opacity of the financing structures and the potential for investors to misunderstand the true underlying financial leverage and risk. Just like Enron used SPEs to hide debt and inflate earnings, critics argue that current AI companies might be using similar structures to obscure the colossal debt tied to their AI ambitions. The intent might differ. One was outright fraud, the other might be aggressive but technically legal accounting. However, the result, a lack of transparency for investors, is where the parallel becomes concerning.
So the risk isn't necessarily that the assets are fake, but that they're costing far more than investors are being directly shown, and that cost is being borne in a way that might suddenly surface as a massive liability.
Precisely. If the market suddenly shifts, or if the demand for AI compute doesn't materialize as rapidly or profitably as projected, those off-balance sheet assets and their associated debt could become a significant problem. It's a bit like building a massive factory on borrowed money that you finance through a complex structure, and then realizing there isn't enough demand for your factory's output. The debt is still there, and someone eventually has to pay for it.
And the speed at which AI technology is evolving, that could quickly devalue these massive investments, couldn't it? Today's cutting-edge GPU could be obsolete in 18 months.
That's a critical point. The depreciation rate of these assets is incredibly fast. Unlike traditional infrastructure that might have a useful life of decades, a top-tier GPU farm could be significantly less competitive in just a few years. This rapid obsolescence means that the companies taking on this debt are essentially betting on continuous, exponential growth in AI demand and profitability to keep pace with the need to constantly refresh their hardware. If that bet doesn't pay off, or if a competitor introduces a dramatically more efficient architecture, these massive capital investments could become stranded assets very quickly.
That's a huge operational risk on top of the financial structuring risk. It's not just whether the debt is hidden, but whether the assets themselves are going to retain value for long enough to justify the outlay.
Absolutely. The speed of innovation creates a unique set of financial pressures. And it's not just the upfront capital expenditure for the hardware. These data centers consume prodigious amounts of electricity. Power and cooling are not trivial costs. They are massive, ongoing operational liabilities. If you're running a data center full of tens of thousands of GPUs, your electricity bill can be astronomical, and that also needs to be accounted for, whether it's on or off the main balance sheet.
So companies are essentially taking on two colossal, somewhat hidden bets. One on the continued rapid adoption and monetization of AI, and another on the sustained relevance of their incredibly expensive hardware. What happens if either of those bets go sour? Who bears the ultimate risk?
Ultimately, the risk cascades down. Initially, it falls on the investors who have provided the capital, often unknowingly. This includes institutional investors, pension funds, and individual shareholders. If the true financial picture becomes clearer and the liabilities are larger than perceived, stock prices could take a significant hit. Credit rating agencies might downgrade these companies, making future borrowing more expensive.
Which can quickly create a downward spiral.
Exactly. Beyond that, there's a systemic risk. If several major tech players are engaged in similar accounting practices and the AI boom falters, the collective impact could be substantial, potentially affecting financial markets more broadly. It could lead to write-downs, layoffs, and a general loss of confidence in the tech sector, echoing some of the fallout from the dot-com bubble burst. It's about how much leverage is truly in the system and how transparent that leverage is to everyone.
It's interesting how the article title specifically mentions big tech, not just AI startups. Does that imply that established, seemingly rock-solid companies are employing these tactics, or is it more of a generalization?
The source implies that this phenomenon is occurring across the board, driven by the intense competition for AI leadership. While startups might have to be more transparent about their financing to secure initial funding, larger, established tech companies have the resources and complexity to engage in more sophisticated financial structuring. They have a greater incentive, arguably, to maintain pristine balance sheets to protect their immense market capitalizations and valuations. So it's not exclusive to one type of company, but the scale of big tech makes any potential issue particularly impactful.
So we're looking at an environment where the desire to be an AI leader is so strong and the capital required is so immense that companies are incentivized to push the boundaries of financial reporting to achieve their goals, potentially leaving investors in the dark.
That's a fair summary. The AI gold rush has created a climate where speed and scale are paramount, and financial transparency can sometimes take a back seat to maintaining growth narratives and favorable market perceptions. The question for investors and regulators will be how much information is truly being made available and whether the accounting methods adequately reflect the underlying economic realities of these gargantuan investments.
In conclusion, the crucial takeaways seem to be, first, the sheer staggering scale of the $1.65 trillion investment in AI infrastructure is almost incomprehensible.
And that this isn't just about silicon, it's about building entirely new, power-hungry computational cities.
Second, there's a legitimate concern that sophisticated financial engineering is being used to obscure the true debt burden associated with these assets, keeping it off the main balance sheets.
Making it harder for investors to truly gauge the financial health and underlying risk of these companies.
And finally, while it's not an exact parallel to Enron's deliberate fraud, the transparency issues and the potential for a sudden revelation of massive liabilities certainly evoke a similar sense of financial precariousness.
It's about understanding the full picture, which in this case might be deliberately obscured. The question for investors and for the entire industry is how long that opacity can last before the true costs come due.
What happens when the relentless pace of AI innovation inevitably makes today's cutting-edge hardware an expensive dinosaur? Who is holding the bag then?
That's all for this episode of Tech Disruptions. Join us next time as we keep exploring the technologies reshaping our world. Thanks for listening. We'll see you next time.
Stay curious out there.